Imagine this. You walk into a currency exchange with 100 US dollars. In Japan, you get about 15,000 yen. In the UK, you get 75 pounds. In Mexico, you get almost 2,000 pesos. Same $100, completely different numbers. Here's the question that breaks most people's brains. Why isn't money just equal everywhere? Why can't $1 equal €1 equal 1 yen? And here's the really weird part. These exchange rates change every single second of every single day. Right now, while you're watching this, the value of your money is shifting. So, what's actually happening here? The answer involves gold, governments, and a system most people don't even know exists. Let's break it down. To understand why currencies have different values today, you need to know what money used to be. For most of history, money wasn't just paper with numbers on it. It was backed by something real, usually gold. This system was called the gold standard. Under the gold standard, if you had a dollar bill, you could theoretically walk into a bank and exchange it for a specific amount of gold. Countries couldn't just print unlimited money because they needed actual gold reserves to back it up. This kept currencies relatively stable and exchange rates predictable. But as economies grew and wars drained gold reserves, countries realized the gold standard was too restrictive. By the 1970s, most of the world had abandoned it completely. What replaced it? Something called fiat currency. Fiat money has no physical backing. It's not tied to gold or silver or anything tangible. It has value for one reason only, because the government says it does and people believe it. That's it. Your dollar, your euro, your yen, they're all based on trust. And when that trust shifts, so does the value of the currency. Once money became fiat, its value started following the basic rule of economics: supply and demand. If lots of people want a currency, its value goes up. If nobody wants it, the value crashes. Think of currency like concert tickets. If everyone wants to see Taylor Swift, ticket prices skyrocket. If nobody cares about a band, tickets are cheap or even free. Currency works the same way. The US dollar is valuable because people around the world want it. The Venezuelan bolivar collapsed because even Venezuelans didn't want to hold it. So, what makes people want or not want a currency? 4 big factors: inflation, interest rates, economic stability, and trade flows. Let's go through them one by one, because each one directly impacts whether your money is worth more or less tomorrow than it is today. Inflation is when money loses purchasing power. Simply put, prices go up, so each dollar buys less stuff. When a country has high inflation, people dump that currency fast, because holding it means watching your wealth evaporate. Let's use a real example. In the 1980s, the Zimbabwean dollar was actually stronger than the US dollar. One Zimbabwean dollar could buy 1.35 US dollars. But then, Zimbabwe's government started printing money recklessly to cover debts. Inflation spiraled out of control. By the 2000s, one US dollar was worth 600,000 Zimbabwean dollars. People were carrying wheelbarrows of cash just to buy bread. Eventually, Zimbabwe abandoned its own currency and started using foreign money like the US dollar and South African rand. That's what happens when inflation destroys trust. On the flip side, countries with low and stable inflation see their currencies stay strong because people trust that their money will hold value over time. Interest rates are the cost of borrowing money, but they also determine how much you earn by saving or investing. Central banks like the US Federal Reserve control these rates. Here's how it works. When a country raises interest rates, investments in that country suddenly pay better returns. If you can earn 5% interest on a US government bond, but only 2% on a German bond, where are you going to put your money? You'll buy US dollars to invest in America. This increased demand for dollars pushes the currency's value up. When interest rates fall, the opposite happens. Investors move their money to countries offering better returns, and demand for the original currency drops. But there's a catch. Countries can't just jack up interest rates to the sky to attract investors. Why? Because high interest rates make borrowing expensive for regular people and businesses. Mortgages cost more, loans cost more, and businesses stop expanding. This can slow the entire economy and cause unemployment. So, central banks constantly balance interest rates to keep the currency strong without choking economic growth. That's why everyone watches the Federal Reserve chair so closely. One announcement from that person can shift billions of dollars around the world instantly. Before we dive into the last two factors, quick request. If you're finding this helpful and finally understanding how currency values actually work, hit that like button and subscribe for more finance concepts broken down simply. And drop a comment. What currency do you use? And do you think it's overvalued or undervalued right now? All right, let's keep going. Investors don't just chase high returns, they also want safety. A country with political chaos, frequent government changes, corruption, or economic instability is risky. Even if interest rates are high, investors won't park their money there if they think the government might collapse or seize their assets. This is why stable democracies with strong legal systems like the US, Switzerland, and Singapore tend to have stronger currencies. Investors trust that the rules won't change overnight and their money is safe. On the other hand, countries with civil unrest, unpredictable governments, or massive debt problems see their currencies weaken. Investors pull money out, demand drops, and the currency crashes. Political stability and currency strength go hand in hand. Finally, trade flows matter. When a country exports more than it imports, foreign buyers need that country's currency to pay for goods. This increases demand and strengthens the currency. Japan is a perfect example. When Toyota exports cars to America, American buyers need Japanese yen to complete the transaction. High demand for Japanese products means high demand for yen. The US dollar became the world's dominant currency, partly because of oil. In the 1970s, the US convinced major oil producers, like Saudi Arabia, to sell oil only in dollars. Since every country needs oil, they all need dollars. This created constant global demand for the US dollar, making it the reserve currency of the world. Countries that export very little and import a lot see their currencies weaken because they're constantly buying foreign currency to pay for imports, which increases supply of their own currency and decreases demand. You might be thinking, why don't we just use one currency for the whole world and avoid this mess? It sounds simple, but it's incredibly risky. Look at the euro. It works great for travel and trade within Europe. But it also means countries like Greece, Germany, and Italy all use the same currency despite having very different economies. When Greece had a financial crisis in 2009, it affected the entire Eurozone. Germany and other strong economies had to bail out Greece, and Greece couldn't devalue its own currency to recover faster. If the whole world used one currency, one country's economic disaster would become everyone's problem. A crisis in one region would spread globally instantly. Most countries prefer to keep control over their own monetary policy so they can respond to local economic conditions without dragging the rest of the world down with them. So here's the bottom line. Currencies have different values because they're based on trust, and that trust changes based on inflation, interest rates, stability, and trade. The gold standard is long gone. Now it's all about supply and demand in a global marketplace. If this finally made exchange rates make sense, subscribe for more videos breaking down the economy, hit that like button, and share this with anyone confused about money. Drop a comment with your currency and whether you think it's strong or weak right now. Let's discuss.